Good morning, ladies and gentlemen. We're here to discuss artificial intelligence and the regulatory changes that are revolutionizing financial services. Combined, these two forces are creating opportunities and challenges for industry practitioners. It's time to reimagine financial services. We're very lucky to have a very distinguished panel of experts to take us on a whirlwind tour of the world of fintech. So firstly, we have Abdulla Almoayed, the CEO of Almoayed Technologies, the first licensed open banking provider in the Middle East and North Africa. And then we have Mike DeAddio, President and Chief Operating Officer of WorldQuant, a global quantitative investment manager based in Connecticut with over $10 billion US dollars in assets under management. And we have Brady Dugan, founder and CEO of Exos Financial. And I'm sure many of you are familiar with the name. That's because he was CEO of Credit Suisse for a decade, and a tumultuous decade at that. It was during the global financial crisis. And then we have Akbar Jaffer, Chief Strategy Officer and Chief of Staff at London-based financial services and software provider FinanceAsia. And last but not least, and representing Asia, we have Kenny Lam, CEO of Two Sigma Asia Pacific, a technology-driven investment manager with an eye-catching $60 billion US dollars of assets under management. And I'm also going to draw on Kenny's experience at McKinsey and China's NOAA for this panel. And I'm Alison Tudor-Ackroyd, Managing Editor of FinanceAsia. Pleased to be with you here today. Earlier panels have drilled down into specific areas of fintech like blockchain and payments. We're going to start at the bedrock. We're going to start at the plethora of data that's out there for you to make use of, and how do you best make use of the data available. I was going to turn to you, Mike, if you'd lead us off on this. So across markets, do you have reliable data sets that you can drill into? And how do you make best use of that to be an efficient manager?
Sure, and thank you, Alison. So I think as one of the two quantitative managers up here, I can say that data for us is the fuel that fires our investment engine. It's absolutely required. And it has been for a long time. Now, with respect to data, reliable data, I think, sure, we have it. What we really look at these days is data is growing, quite frankly, exponentially on every axis you can think of. In the developed markets, you're all data sources. Look down at the device that everyone's looking at right now, and that's a data source. It's amazing what you can buy these days. We have over 1,300 production data sources right now that our 350 researchers look at to find trading signals or alphas on a daily basis. Last year, to give you some sense of scale and scope, we trialed 1,000 data sets, of which we bought some percentage. The data game for investment managers such as ourselves is really about scale, throughput. No one data set these days will make that big of a difference, but not having a wide diversity of them will. So you must continue with the diversity of the data sets out there. So it really is absolutely essential, and I give you a sense of where is competitive advantage. If you can just buy it anywhere, emerging markets, you can still find some alpha of your own institutional sense of looking for it, China especially. It's very early stages from a data provider perspective. So we have 2 full-time people in China just looking and searching for data sets. The other thing I think on data is you can begin to make your own, and this is truly a competitive advantage going forward, both by scraping the web, but also by putting pieces of innovative technology together and making your own. Good example, there's software that will assess the tone of voice for call centers as to how shall we say, upset someone who calls in is. If they did it for me, they would find out usually when you call your phone company you're upset, but you can potentially take that, could you apply it to earnings calls and get a sense of the tone from the tone of how the CFO is talking about the company, and is that something you can use? So it's amazing how it's growing. Reliability, not the issue. Diversity and scale really is these days.
Thank you, thank you. Kenny, if I can turn to you. I know you're based in Asia. Have you, in these markets, is there also a reliable data set for you to work off? And I'm looking, and we're all using the ecosystems around the region. How are they amplifying the data that they've got hold of?
So Alison, thank you for including me in the panel. We all know that in Asia, I think there are a large number of ecosystem of data that's being created, right? So in China, there are probably over 10 ecosystems. There are over 100 million active users per month. What we're trying to work with is not just to get access to data, but find a way to be part of the ecosystem, right? So how do you balance between what we see in terms of heavier regulation on usage of data and be able to be part of the ecosystem that can use the data in a very legal and compliant way? So that's one thing we have to make sure that we are working towards. Second is actually now access to unique data is no longer a competitive advantage. I think how fast you can interpret, so processing power, and how you bring your experience in interpretation are two areas that will really bring differentiation. Last point I do want to make is talking about how we are part of an ecosystem. You still see a lot of these ecosystems, although they are creating new networks of data and new ecosystem on a day-to-day basis, the data that we see are still extremely raw. So there have to be layers of featureization that needs to be worked on before they create any type of signals. And so a lot of the work is not just about getting access to the raw data, but actually spending a lot more time in how we featureize and how we think through that process. So we're building our capabilities on that front too. We think that the next generation of quant investing, systematic investing, is not just in getting a lot of data, but how do you make sure you build on your experience, successes and failures, and be able to interpret in a much better way.
Akbar, to develop that point a little bit further for broader financial services, let's take it for granted there are troves of data out there. How do people in the audience better access that data, store it, and analyze it, in your opinion?
Yeah, no, great question. So, I mean, Finastra is a software provider, and we have 8,500 customers. So our software is quite deeply penetrated into the financial services sector. You know, it powers 70% of syndicated loans globally, 5 to 6% of FX trades, 5 to 6% of daily trade finance. So there's a lot of data there, as you said. The key is how do you access it? So we've taken a couple of approaches here. We've created a platform, we call it Fusion Fabric, which essentially opens up the APIs for those core banking systems, right? And what that enables an institution to do is essentially use that cloud deployed platform to create data pools. Now, you obviously need the human capital. That's the technology capital, but you need the human capital to bring those data pools together. And therefore, opening up those APIs also allows third-party applications to come on top to do prediction and analytics, for example. So the US example for us, we have 4,500 bank customers in the US, and there's a startup there, or there's a young fintech company called Moderator. And what that does is it takes our platform, comes on top, builds an application that is then deployed by the bank, particularly for millennials, who can then do goal setting for savings. They can look at, Monato can look at their account and look at the behavior in those accounts and come up with predictions about things that they can do with their money, and particularly opportunities for the bank to propose specific products for them, right? So that's within the bank and the enterprise. Also, the platform that we're developing also allows for collaboration between banks. So take syndicated loans, for example. If you create a marketplace for syndicated loans using this platform, you can bring various inefficiencies and value chains together that allows the pooling of information and to get further insight. So, the key is technology-enabled data pools to create connectivity. And then if I think of Asia, Asia still has a huge opportunity in front of it. I think I read some Citibank stats that said, I think 50% of folks don't have current accounts, 90% don't have credit cards, but 90% have phones. Yeah. If you think of the phone as additional capture points for that data and data insight. So that's the approach we think about getting hold of that data and analysing it.
Thank you. Brady, would you say the institutional side of the market has been a little bit slow in using the data sets available for them? How do you think that they could do a better job?
Mm-hmm. Well, I think in general, the institutional, sort of the wholesale side of the business has been slower to adopt a lot of the technology. And I know everybody who's been involved in the industry have kind of been asking this question for a long time. Why haven't the kind of wholesale, particularly sell-side business models, done more to develop their business? And that's really our thesis now, is that this is a time when actually, given what's happened with technology, given the regulatory backdrop, that it's a time where you could actually, it is a huge opportunity to create a platform technology on the wholesale side that can really take advantage of both the data and the technology advantages that are out there. And we would certainly echo all the comments that have been made here about, there's clearly, particularly the asset management side has done tremendous things with, sourcing data, using data. We're much more focused in our business model on using data to improve the customer experience. So in terms of a, sell-side customer business, and improve our efficiency, improve our ability to advise and provide product to them, but also improve their ability to actually manage things. And I would also echo, our view is that actually finding these new sources of data is something that's really exciting and tremendously, there's tremendous potential there. So one of the things that we've done, for instance, is we've actually created a digitalization technology that is state of the art that we're using to actually digitalize all financial legal documents. And so if you think about it, there's this huge amount of data out there. Basically, most financial institutions are really just the sum of their assets and liabilities, each of which is actually embodying in a legal agreement somewhere. But what typically happens is you spend weeks, months negotiating your legal agreement, you sign it, and then you basically turn it over to the operations side, and they basically put 5 things in the system, notional principle, et cetera. So it's there's like all that time and all that information is stuck in those legal documents, not digitized, not used. So one of the things that we've developed, and Joe Squaries, our head of technology, has done a tremendous job developing really a landmark technology that allows you to digitalize that information and turn it all into actually searchable machine, searchable source data, which makes it really interesting information and creates an entire new set of data that is very helpful to the customers, but also could eventually have a lot of interesting applications elsewhere as well.
Yeah, cool. Abdulla, I want to bring you in on this because I understand that you spoke to the regulator in Bahrain and you convinced them that they really needed to give financial services a fillip in the region by bringing the government data into digitizing it. Could you tell us how fast that happened, and has that created innovation across the region?
Yeah, I think our situation's a little different. I mean, the Gulf region is a new economy. It's no secret that oil is running out. Data being the new oil, I think, has given it that level of importance. Mm-hmm. How do we create an industry out of oil? How do we create downstream and allow analytics? How do we avail this data, which at the moment was not existent? Mm-hmm. There is a very live case study. I can use Bahrain as an example. They started off by availing data centers, bringing in AWS, setting up a MENA operation, and then really implementing what's known as a cloud-first policy, enabling or mandating the entire government to move on to the cloud within a 12-month period, which is unheard of. And then really within 12 months, and then giving the rights to the data to the people. It kind of creates this ecosystem of the data is now available, and then starting to mandate certain sectors, like open banking, mandating all the banks to open up. You add on to that a digital identity number to every resident, and you create, instead of having to search for data, you're really availing these data points, and when it's mandated, you take that in connection to a digital identity number, and it creates a very unified ecosystem of optimized data sources that are efficient. So we're kind of leapfrogging a technology when it comes to screen scraping and a lot of the methods that are used by my colleagues on the panel. But we're going straight into direct API integrations through the entire ecosystem. That on top of the government actually starting to avail APIs including AKYC and many other initiatives.
Brady, I'm going to bounce back to you, if I may. I've seen over the last few years Google doing a Dutch auction and Slack eschewing investment bankers altogether in their IPOs. How do you see the distribution of equity in equity capital markets in the future? What can the investors in the audience expect? Will it be fairer?
Well, I think our view is in general that bringing technology, bringing data to the whole sales and trading business is something that has tremendous benefits. And so it's really, I mean, in our view, the scale of that business and the nature of that business makes it very much like an Amazon or an Alibaba type application. I mean, the application of data analytics to those processes is something that could be, hugely beneficial and, could drive some really major changes in the business models as well. We certainly think also in terms of primary issuance, that's also one where, that's a process that hasn't really changed for probably 20 or 30 years. And, there are definitely ways to make that process more efficient, to make it more effective, whether it's, as you say, some issuers have tried Dutch auction type processes, systems that may promote that, certainly technological ways of making the whole process of actually telling a company story and taking the company public are things that, have to be much more efficient, more effective. And I think those are coming. I mean, they have to. And as you say, the companies are forcing it. You have companies that are just completely bypassing our industry, going directly to listings, without going through that whole process. And, if the process doesn't improve, that's probably just going to continue. And so, and I do think at the end of the day, one of the most important functions that our industry has is to try to, funnel capital from those who are long capital to those who can use it to productively build businesses, build jobs, et cetera. And, I think, the industry spending time on figuring out how to make that more efficient, more effective is something that's very important, and it's got to happen, and it will happen.
So less fat fees for investment bankers going forward.
Probably things can be done more efficiently, yes.
Which is why Brady's not at a bank anymore, I think. Having worked at Credit Suisse when Brady was there, which was a phenomenal time.
Back to focusing on the investment management business. Does tech really help you stay ahead of the pack in terms of performance and efficiency of your outfits? Could you talk to a little bit about that?
Kenny, you want to?
Sure. Well, I mean, I think the question is no longer whether or not it actually is going to help. It's actually more how fast can we apply it and how much can we evolve, given technology the innovation has been so intense that we have to find ways to take it on and apply it in a very quick way. I think we're basically doing two main things at our firm. One is we want to make sure that we attract the right talent, not only in the US and in Europe, but also globally. And so we're building partnerships globally to see how we could find, not only, for example, in China, not only Beida and Tsinghua, but a lot of great talent coming out of China that are great engineers and great coders and great data scientists that we should be attracting so that we get that pool of talent, one thing. Two is, I think I mentioned this before, is how do we work with innovators in the region? I think you're seeing new innovators coming out of this region for a few reasons. You've got such a large pool of active users that are creating ecosystems that reinforces itself and build new innovations on it. So you can pilot new things much more quickly. Second is they have got a lot of capital. So you can put a lot of capital to use in this area. So how do we bring our firm to this region so that we learn from the region? I think technology is rightly a great approach for systematic investing, but it's also challenging because you don't have kind of an end goal. It's continuously evolving. So how do you build that global firm that can take on new talent and new thinking on a constant basis? Is something that we deal with on a day-to-day basis.
So to add to that, it absolutely is, it's an arms race of technology, but in a very different way now. It used to be buy the faster machines, have the best hardware. It's now evolved. It used to be, I think it would be fair to say 10 years ago that in a systematic investing shop, you would build as much as you could because you thought you were the best at it, and it wasn't out there. But now we have to shift to the fact that technology regionally around the world, I mean, 70% of our workforce is in Asia, over 800 of the 850 people, so we've been in Asia for a long time. But now what you're finding is you have to find the tools, not just the hardware, the TensorFlows, all these different tools out there are already ahead of what we could do ourselves because the world has innovated so quickly, a lot in Asia as well, that we can now use to augment data sets, to, as I said before, figure out what's the tone of the voice, and so on and so forth, convert Chinese language articles to English and then run a sentiment engine. It's all out there. So we no longer have the lock on that. So from a technical perspective, one has to stay up with the innovation as much as the hardware. It's like Moore's law sort of tailing off, but you get that back in terms of the software innovation that's going on around the world. I did want to add one thing. I learned that millennials now have an app that can tell them they're spending too much on beer on Saturdays. And I'm thinking about how that would have been when I was in university. That's quite compelling and changed the world.
Credit
You
score
learn.
change.
That's right. There you go.
One data point I want to add is recently I've talked to a lot of fundamental managers. You're starting to see them add teams related to data scientists and technology. And now I think what you're seeing though is that they're not yet a core part of the whole investment process, but you are seeing even fundamental managers really trying hard to incorporate that as part of the process too. That's something that I think it's quite
boosting performance for them, or jury out?
Well, the jury is still out in terms of their performance related directly to the teams they add. But I think they're quite conscious in making sure that they don't miss the boat in terms of technology. I think another thing is you've got star managers looking at a vast amount of information. I think the only way they could actually take on that information is to bring technology in. I mean, there's no way that one person can take it on and make judgments.
The infamous quantimental word, which no one's quite sure what it means.
Yeah.
Quantimental, yeah.
I keep making fun of myself. I recently joined the firm, and I said I'm probably the least educated guy in the firm because we've got probably 800 data scientists in the firm who are non-financial sector related, 300 PhDs, many of them actually double PhDs. So when I sit in the room, I'm like, sorry, I'm the least educated guy in the room, so help me. But I think it's the new evolution, a new way of doing investing. Yeah.
Akbar, I'm guessing you don't agree with the economists in the 80s that said, investment in technology isn't really going to improve your efficiency. I don't think that's your ethos, right?
Yeah.
So if you look at the numbers, right, the financial services industry spends approximately 450 billion on IT and IT-related services. 450
billion.
Yeah, that's the annual number. And what we've seen, I think, is a growing shift. And if you look at the numbers going forward, historically, 90% of that has really been institutions building their own technology capability. About 10% has been buying it. But if you look at the numbers going forward, that 10% is increasing at the fastest rate. In fact, Asia is leading the pack. So I think what financial institutions have figured out is that there are people in the market who can probably build a solution, and then they can buy and use it effectively, right? And so I think you're seeing this increasing shift towards either institutions buying more software or partnering for more software, right? So that's one thing. I also think that looking forward as well, and by the way, it's interesting to note that a lot of the new banking licenses that are getting issued around the world, if you speak to a lot of those companies, they have a much higher propensity to go buy software in the market rather than build it. So there's a lot of lessons that I think have been learned historically around that, right? The second point, I think, is that technology also is being used in different ways, right? So the deployment of technology, so cloud, right? Open APIs, for example. These are things, blockchain, for example, these are things that are going to accelerate return on investment on technology, particularly, I think. So I think there are probably, we all know projects that have technology spent historically, which may have not gone the way that folks had imagined, but I certainly think there's a shift happening in the way institutions are using and buying technology on a go-forward basis.
Yeah, can I just add on to that, onto Akbar's? The open banking initiative in Bahrain was the exact example of that. We saw how it happened in the UK, and a lot of people developed proprietary APIs in these banks. Developers don't want to develop to them. In the case of Bahrain, what we did is we tightened up the time frame. So the regulator mandated it within 6 months, saying to banks, you got 6 months to comply. And the only option there is to really look for solutions and third-party solutions. Not look for proprietary APIs, go to third parties, bring them on board, integrate them. And really what we've been able to do from a current standard is a reference point to be able to take an entire ecosystem live with open banking in 6 months creates a very compelling proposition, but it's really because banks stick to what they're doing and what they do best and let the technology be developed by technology providers. Yeah.
I imagine this trend is also going to impact wholesale, institutional side. And
No, I think it's absolutely right. I mean, there are dramatic improvements from the more modern architecture of technology. And one of the biggest issues is that you have all the legacy institutions that are, for a long time, as you mentioned, they've had completely closed environments. They've run their own data centers. They've written all their own software. And that compared to the new model of processing in the cloud, licensing in whatever technology you can find that's adequate, it's a dramatic difference. And so you end up with not only a lot smaller spend, but you end up with a lot more of your spend going to developing new concepts. And we always used to talk about, for a traditional bank, they talk about run the bank versus change the bank, right? So you'd have like 80% run the bank, 20% change the bank. So you only had a small amount of so that 450 billion, 80% of it or maybe 70% of it was going just to actually run the existing operations. What you find when you go to the more modern architecture is it flips, and you have 15 or 20% of your cost. So it's like, for us, 15% of our cost is run the bank, and 85% can be used to develop new applications, new solutions for clients. It's much, much more efficient. So it's a dramatic difference, and I think as the whole industry goes that way, I mean, you're mentioning that 10% and the new entrants doing that, it has to happen throughout the industry. It just has to, and as that happens, it's going to dramatically increase the efficiency and the effectiveness of that spend. It's going to just deliver more and more to customers.
So just to add to that, run the bank, change the bank, reminds me of, we used to call change the bank, and I can tell you this now, kill the bank, given how bad we were at it. But there's a social dynamic to this as well. Millennials, especially, we're coming out of university, and we hire pretty much right out of university. Our median age at the firm is 28. They don't want to work at banks anymore. Right? They want to work in a dynamic setting. They don't want to have a big legacy. It's just, you also can't find the talent to do it that way anymore. So the social dynamic is sort of forcing everyone's hand too. And then you're so far more efficient with people who really like what they do and they're being innovative, because you just can't be innovative, quite frankly, in regulated industries as easily anymore.
Absolutely right.
So you can't even hire them. It's really hard.
When you're forced to come into an organization where they force you to learn their programming language, which is not used anywhere else. People are like, why would I do that? Why on earth would I do that? It reduces my marketability, et cetera. So you're absolutely right.
And notice on the panel the two guys not wearing ties.
No, and you see the whole dynamic shift onto people trying to really understand their customers, as opposed to let's deliver products, push these products as fast as possible as banks. It's really, let's start looking at these customers, understanding them. What are they looking for? Let's start focusing on smaller niches, more interesting stuff, and give these products to the customers when they need them.
I wanted to dive a little bit deeper into open banking. We're seeing jurisdictions across Asia, Hong Kong and Singapore, turning to open banking. But what's hindering this process? Surely this is a good thing for the customer. And what's the drag? Why aren't we seeing this more?
I think there are three factors. I think trust, regulation, and the power of the incumbents. I think in the case of, let's take the UK, for example, the CMA9 are very much in control. Banks don't really want to innovate. So if you take the prerequisites, if you look at the enabling the trust, getting the regulation, if I would have asked you 5 years ago, drop your kids or onto school with a car with a stranger, you'd probably say no. And the Uber proposition, I mean, we've seen market capitalization as far as logistics or transport companies take over with Uber. We've seen that happen in hospitality with the likes of Airbnb. Financial services on its own, I think in the US, is like a $6 trillion or $7 trillion economy. We haven't seen financial services get taken over yet. And that's really the power of the lobbying capabilities of these banks. It really hasn't opened up. It hasn't transformed to what it could be. You're still treated by your banks like someone that doesn't know you. You're still not getting the kind of products that you need. Your analytics are not being run. And that's what I think should be or will be changed very fast. And it's these three factors. I think once the regulations are in place, once the trust is there, and once the power of the incumbents slightly is loosened up, you'll start seeing a lot of transformation. And I think the UK is a good example of that. I think the Gulf region is about to transform very fast, and we're optimistic.
I'd also add to that. Actually, I think I want to build on it. I do think things are going to accelerate quite soon. You're seeing regulators now changing in Hong Kong and Singapore, being a lot more open-minded about issuing virtual licenses. So I remember back in the day when in Hong Kong, it takes a long time to even discuss about having everything go online for opening a bank account. And there's a certain tipping point where the regulators finally realize that you're going to have to get with the market and really go accelerate. The second point is the point that you make, Michael, which is around the millennials. I think they are not used to using a branch. They are a lot more used to using a mobile device, and they are the clients of the future, and they will push the providers to change. You're starting to see that in China, where they completely skip a generation, where if you go on China now, if you carry cash, you can't do anything. And so I think both the demand from the new millennials as well as the regulator changing, I think it's going to really make a big difference to acceleration.
Akbar, you're sat in London, and the UK was a first mover in this field. Did they get it wrong? Can we learn? Or what can we learn from them? Let's put it politely. And
Yeah, so I think my assessment of this is the UK was one of the earliest, and they mandated, right? I think if you look in Asia, people can correct me if I'm wrong, but Singapore, Hong Kong, Malaysia, Korea, they take more of an organic approach, right? And so, I mean, it's fair to say that anyone who goes first, the second movers always learn from the first movers, right? So I think there is that dynamic to it. I think it's a broader question, though, if I may, which is, open banking is really about, I've touched on it before, which is this API economy, right? And it's really fundamentally to do with the bank strategy. I mean, regulation helps set the tone, and they can mandate it, and it kind of moves people in the right direction, right? But it's really about incumbents and their view of how they want to tackle the market, right? Do they view the new fintechs as competitors, or do they collaborate with them, right?
has the market share changed in that?
So the data I've seen, I think I saw some data from Accenture that basically said, I think 10 years ago, there were about 26,000 financial institutions globally. There was consolidation. It went down to 17, and then 3,000 new fintechs. And we can talk about the definition of fintechs have come in. They've captured roughly about 50% of the new growth of revenue in the market. The UK is a standout, actually. The new players there are 65% of them are new fintechs, effectively, and they've captured a lion's share of that revenue growth, new revenue growth as well. So, I don't know if the two are related to open banking and whether they were first to move, and that's going to be replicated across the board. But I do think it's a broader question about what incumbents do and how they use open APIs, and they can use fintechs to provide new services to their consumers and to their corporates, right, in a collaborative way. Because fintechs also have an issue about distribution. It's very hard for them to scale. They don't have the balance sheet. So there's a natural coming together potentially, right, of fintechs and incumbents. So we shall see how it pans out. But certainly I think the UK did set the tone. But as I say, second movers generally learn from the first mover, right?
Yeah, I think can I just add on to Akbar? I think the open banking is a reality and it's inevitable. It is happening. Open APIs are the future. The only question is which jurisdiction is going to accelerate the process. We all know what's going to happen as far as decentralization. Banks will be commoditized or turned into utilities where they'll process payments and do a lot of the trust work. The top layer is going to become fintechs. Fintechs are going to integrate into these banks. But how do you accelerate that process? And that's where I think regulation plays a big role. And the way the banks look at it, and I think going back to what I said earlier, here the case of the UK is a beautiful reference point, but it's really, we're seeing fintechs complain. They'll be the ones that judge on whether it was done right or wrong. The question is where are these fintechs going to go to next, and which regulators will legislate fast enough and mandate fast enough to be able to embrace these. So I think this is going to be a very interesting year going forward, to be able to see where these fintechs go, to really get that fastest go-to-market, because banks are sitting there arms wide open, waiting for them to come and then propose their solutions to their existing customers. Yep. So you'll see partnerships, you'll see acquisitions, you'll see a lot of these partnerships, which we really haven't seen until today. So I think it's a very interesting year ahead when it comes to the integration of fintechs.
Brady, I'm going to bring you back. A big question now. And it has competitive and geopolitical ramifications. Is China ahead in the fintech race? And looking at some of the players there, are there things to learn from those ecosystems? What's your view on what's coming out of China right now?
Yeah, I mean, obviously, different countries, different regions of the world are, sort of proceeding at different paces. I definitely think some of the models in China obviously have grown very rapidly and are very, very interesting models. But they approach things differently. If you look at the things that a lot of the people on the stage do, those kinds of entities, I mean, you don't have a lot of competition in China. On the other hand, if you look at an Alibaba or some of these other business models, that's a tremendous model. And frankly, there's a lot to learn from the way that they pull data together, integrated, et cetera. Not necessarily that unlike Amazon either, but with probably a more financial bent. So in my view, there's lots of innovation, lots of things going on in many different areas. Certainly there are models in China that are really interesting and that I think are showing the way for how to build broader platforms. And frankly, from our point of view, the kind of business we're looking at, trying to build more of a platform technology, those are pretty interesting models to to emulate. Being able to have a broader platform where you can pull together the information and really leverage that, and you can see the value of that in an Alibaba or an Amazon. So certainly some very tremendous business models. But again, it's a little there are different parts of the landscape, I think, in different parts of the world.
So Kenny, you were president of China's NOAA, one of the largest wealth and asset managers in the country. I'm sure you've got a view on this. What did you see? What did you?
In my prior role, I'm such a promoter of the country that I want to say something a bit more controversial or maybe counterintuitive. I think you hear a lot about scale in China. That's natural. But I do think that all the firms in China have been competing in a closed system. And so if you look at the bigger guys, the Tencent and Ali, they have been trying to export what they have built to other countries. I don't think you've seen a successful case yet. A lot of it is because you have a closed system of active users and it allows you to innovate quickly. But if you bring that system to a different market, I don't think you have that ability to do MVP on a weekly basis. Not that eventually we see a great global Chinese firm that can export the model to a different market, but I haven't seen it yet. And so, right, and so exactly. So a lot of headlines is about Tencent having 1 billion users, but indeed it's a closed system, and so they have been extremely successful in one market, and I think it takes time for us to see if they could prove themselves globally. I think.
Mike, I know your firm has been in China for many years, and I believe you're growing in China as well, looking to grow. In the investment world, you still got an edge there on what you see and how the market works.
Yeah, so for us, we've had quantitative researchers in China for well over a decade, 11 plus years at this point. It was our first foray outside the US for our research quantitative talent back in 2006, before my time at WorldQuant. I think our founder sent someone there who was a Chinese national to interview 1,000 people, and we hired the 5 top ones. And sure enough, we could make trading signals there much, much faster, better, with higher quality than we could in the US, which says something about the US, but we'll leave that aside. But the hunger was there, the intellectual prowess is there, it still is. The market's developed a lot. I think we still have a great edge because our China office at about 80 people between Shanghai and Beijing is still our top office in terms of producing quantitative output, but it has now been diversified. And as was said a little earlier, I think it's a phenomenal market for talent, but it's not as competitive. They're not as used to competition as we are in the rest of the world. And that's very ingrained in, I think, the social norms there, where things are more cordoned off. So as we have other research centers out there, we see a diversity of talent. But I think that China still has a tremendous talent bank, and we continue to grow our research there. But now the rest of the world is catching up. The rest of the world, our actually biggest office outside of China, of our 28 in 17 countries, is Vietnam. There's almost 100 people in Vietnam between Ho Chi Minh and Hanoi for us. So the rest of the world is catching up in lots of ways. It's not just China any longer, although it's still a very big part of our organization.
I do want to add a point to what Mike said. I think we were just discussing pre-panel. We can't ignore a market like China, so we're going to have to find a way to learn from it. Put a lot of people in, just learn a lot and try and fail. We actually today we announced that we actually have a new private fund management license approved by the CSRC actually today, and so for a firm like ours, it's a big step because we've been global, we've been trading in China for a long time. To put someone onshore and to get a license onshore, it's a big step, and it's also indicative of the time that we have to spend time in a big market like China, or in big markets in Asia, that we have to learn from these markets.
It's a 10, 20-year investment. And it's great to know that Kenny just said that, because it helps me with my bosses to convince that we should do the same thing. That's why these panels are wonderful.
I guess that's
Got
a
on
bit of
tape too.
Yeah, I know. I'm going to play that exact
Yeah.
snippet, by the way. I'm using that.
It's a segue, I think, into, you've invested so much in technology, and how do you protect that edge that you've developed carefully and nurtured in terms of intellectual property in emerging markets? And it's got to be at the front of your mind when you're expanding in these countries. Do you want to?
Well, one, from a technical perspective, we keep our data centers in countries where we have high regard for the intellectual property right laws and the judicial system. So that's one thing, and that's the technical aspect of it. From a personnel aspect of it, our model is we have so many trading signals and so many people and so many research offices. We don't worry so much about any individual person leaving. Of course, we have non-competes, but they're difficult to enforce all around the world. You do that, but more so it's the structural aspect of how we're structured. And you can't worry too much about that because it's not solvable on any large scale. The biggest thing is to produce a lot of output, have high quality research around the world, and that problem sort of takes care of itself. Mm-hmm. So we don't worry so much about that these days.
Mm-hmm.
Well, it's an issue for markets like China where the perception about IP risk, I'd say perception because I think some are reality, some are perceptions. We have to find a way to ring fence the risk. We're not saying that we shouldn't even do anything in onshore China, but we have to be a bit more nuanced around what is exactly the IP risk that we are worried about and how we actually ring fence it so that we're comfortable. So we can't just say blanket, we're not going to do anything onshore. So I think we're figuring out the balance. I don't think we're there yet, but I think we'll find a way to do it. Yeah.
Brady, turning to you. Kenny's already talked a little bit about talent and nurturing, finding these data scientists or the skill set that you need to propel your company. Or is there a dearth in talent? Is that actually a drag on growth at the moment for many of the cutting edge firms? I'm sure you spend a lot of time on this subject.
Yeah, well, I think it's I think the traditional financial industry was a very, if you were good at technology, you want to work at Google or you want to work at, Alibaba or Amazon. You don't want to work at a bank so the traditional businesses it was a very difficult problem. And as CEO of Credit Suisse, people would say to me, your biggest problem is nobody's any good at technology who wants to work at a bank. And I think there's some truth to that. Obviously, there are a lot of good technology people, but in the past you wouldn't aspire to do that. I actually think that creating these new models with modern architecture, modern technology approaches, where you really are, because a lot of people, that's what they want to do, is they want to push new frontiers, they want to build new things, they want to be at the forefront. And honestly, actually, I think they view the financial sector as one which is kind of one of the last great, unconquered sort of horizons from a technology point of view, and they want to be part of the group that helps to revolutionize that. And that is actually, I think, creating a tremendous source of talent from the more traditional technology worlds. We have we have Googlers and Facebook people and Microsoft people, and they are very, very frankly, in some respects, our businesses are more interesting to them now than those other what would be considered the more traditional or in the past sexier sort of technology businesses, and that's a very interesting development. I mean, you can get the very best people now who want to work in our businesses because it's exciting and it's a new frontier. It's really good.
And we give them ping pong tables and we give them fun. We don't make them wear ties.
Make them happy.
But to just add on to that, I mean, at World Quant, there's no reason why it says world, which is we actually take the opportunity where the people are. That's why of our 850 people, 80% are outside the US, mostly in Southeast Asia, and now 4 countries in Eastern Europe, because the opportunity is missing there, but the people are just as smart, if not hungrier, and you bring that opportunity there. And I don't want to give Kenny any ideas, but in Vietnam, 2 Sigma's not there, right? So when we're hiring, our hire to offer ratio is 90%, some years 100% in some markets. Try that in San Francisco, try that in Singapore, try that in New York. You're competing with everybody. So this democratization of opportunity that we see at World Quant is out there, and you can find amazing talent if you're willing to go where it is. And the whole immigration issue that's going on in the Western world doesn't help bringing people to the UK or the US. So you have to go and get them where they are. And that is one of our competitive advantages that we continue to press as we open more offices. Our next one is Estonia, and that's one country that's going completely digital, right? So it's going to be really interesting. I haven't visited there yet. But this is the way of the world, is you have to bring the opportunity to the talent to get the very best.
Yeah, can I, on top of what Mike said, I think developers nowadays and data scientists want clean data that's available to be able to execute on, run their algorithms, but also they want an environment that they can work. And if open banking is being challenged, if a lot of these initiatives are being challenged because of incumbents, they'll start looking for jurisdictions where they can actually innovate. And innovate is not looking at small niches or to truly be able to transform economies is what a lot of people are after.
So we're doing something quite unique, adding on what the panelists said. On the talent point, for a New York-based firm like ours, it's a big step where we start striking partnerships with local firms to attract talent. So we did one in China where we did a partnership with Ping An and the Wharton School to basically train about 150 data scientists per year. And we've never done this before. The idea is that while the brand 2 Sigma is good globally, we have to be local. And so we work with a local firm like Ping An, and we'll be able to access 8 great universities we've never thought about attracting talent from. But that's something that I think we should try and innovate with. It's, how do you become really global local with talent?
And Akbar, where do you find a data scientist that can also hold a conversation on the strategic elements of the business that is conversant in both sides of the... Are these unicorns? Are these hybrid people?
Glad you asked him that one.
So just to add on the previous conversation, I do think, with traditional firms, you need to show recruits that you have the right structure, because a lot of new ideas, moonshots, they need to be incubated, so you need to have the right structure. You need to make sure you're putting the right talent. You need to make sure you're putting the right capital in and setting the right culture, right? I think you get those things right, traditional firms can amply attract the right talent. Coming to data scientists, I mean, we have data scientists, and they tend to come from a mathematician slant, obviously, right? Data scientists. So the gap is really about subject matter expertise. So what we find is folks will come in, they can run models, they can do all the analytics, etc., but they then have to go and speak to a subject matter expert. Clearly, ideally, what you want and where we're heading towards is they have both aspects, right? So they understand the sector, the subsector, the business issue that's being solved. They understand how to train the models, get the data, and marry the two so you come out with more insight, right? And that's, I think, the challenge for universities, for countries, for us, to make sure that we can develop talent in that way.
Akbar, let us know when you find them.
But I think culture is such a critical aspect.
Absolutely.
And I joked earlier about the ping pong table, but when we run our quarterly surveys on employee satisfaction, always in the top 3, because it generates camaraderie. Typically, mathematicians, we sit behind our computers all day and you don't socialize as much, so you need a reason to do that. Culture is so important, especially hiring millennials out of the universities, but to then encourage them to want to ask the questions, why am I doing this, not just go do it. Yeah. And that's essential, and without the cultural aspect, you can't get there.
We have a program we run globally, we call them high performance entry level, right? And these are the things we put in place to make sure we attract swathes of folks coming in there. So you're absolutely right.
Yeah.
I'm going to turn to the audience shortly. So if you've got any burning questions, don't let this opportunity slip through your fingers to raise your hand. But to wrap up, I'm going to ask you guys a quick question. Where do you see the most disruption in financial services over the next 5 years? You can name a region, you can name a segment of financial services, but you have to be quick. And who wants to kick off on this one?
I'll go first. I mean, I'll be specific. Insurance in Asia. I think what you see is low penetration. You're seeing a shift in behavior of clients. You're seeing vast amount of data that could be helpful for the whole process. Client profiling, risk assessment, underwriting, claims assessment. All that is actually now ripe for disruption. So insurance in Asia.
There's plenty of pain points in insurance,
Exactly.
isn't there?
Yep.
Yep.
Oh, briefly. So
Yes.
I think payments already started, more to come. Picking on a couple that are closer to my heart, which is trade finance.
Yep.
And I also think syndicated loans. I mean, these are big markets that have a lot of inefficiencies in, so I think they're ripe for disruption.
Yeah, I guess my view would be the wholesale side, because I think that's the farthest behind. I think it's done the least. If you talk about payments, other areas, there's been quite a lot done. So I think sort of the institutional side of things, and I do think this concept of a platform with think of a major investment bank, but with an Amazon or an Alibaba-like capability, and putting that together and pulling it together. I think that's going to be a huge development over the next 5 years.
Indeed.
I'll go with something more geeky and technical. I think that what we're seeing in AI, because we didn't talk about it that much, but just really deep learning, it's now gone to a point where you don't have to be an expert anymore to use it. We've passed that point, and the tool sets out there, which are continuously developing commercially, Google, also we have an office up at MIT. What's coming out, now your basic data scientist can just be a practitioner. They can just use the tools, and that opens up that set of technology into a much broader, orders of magnitude, bigger set of people that will produce things that we can't even think of right now. So going from only experts can use it to practitioners, you don't have to be an expert, it's just another set of tools, changes our world. And that's what we'll see in the next 5 years. I can't tell you what it will change, but add that number of people and it will change a lot.
Fantastic.
Yeah, I think we'll see over the next 5 years the conversion of banks into utilities much faster than we expect. I think it'll happen in jurisdictions where the digital strategy is well defined, and we'll start seeing them in these jurisdictions before any others. And the whole introduction of people engaging with fintechs much more than they engage with their banking services.
Thank you. Food for thought. Any questions out there on any aspect of fintech?
Yeah, so the elephant in the living room is the way in which banks, work with regulators to co-opt the competition in order to either kick them out of the franchise, the cartel, or else co-opt them. And how do you keep yourself from being co-opted into, the status quo by regulators?
Well,
Is that a real danger?
We've only seen one regulator globally that has done that yet, and take the hammer in the hand and kind of break the consortium and say, this is over. And that happened in Bahrain. I think it's too early to tell. There will always be resistance when it comes to banks not wanting to share these APIs or share that data. We've seen it in the UK, but I think it's a little early to tell. Until banks start seeing post-compliance. If the banks start realizing the value proposition of being, instead of selling one product, being able to sell 20 and really engaging with your customer, it's the banks that see that'll start leading, after which we'll start seeing the herd effect, in my opinion.
I think we've seen in the US, for instance, our experience has been the opposite, which is probably the biggest frustration that regulators have is the technology in legacy firms. I mean, it's just, it creates intransparency. It takes forever to get numbers. It's very, very difficult. And so when you actually go to them and say, as we did, we're building a new firm. We want to build it in partnership with you. What do you want to see? complete transparency. We'll give you real-time numbers on every aspect of the business. They couldn't be happier. And they absolutely embrace that. I mean, you know, we have a head of our regulators on our board. The previous head of the regulators on our board. They love the approach because technology can make them much more effective, make their jobs much easier, and create a transparency that is really helpful to the system as a whole. So I think it's actually the opposite.
Did it answer your question? Any others in the audience? Maybe a question on privacy or? Yeah.
Hi, I was just wondering what's giving you the impression that the banks don't want to open their APIs in the UK, for example, because they have done so. In our bank, I'm with HSBC, we actually partnered with a fintech and worked within the regulatory sandbox to create the marketplace model of open banking that you refer to. So if you had any examples of what you meant by that.
Yeah, reported resistance, downtime, failed API calls. We've seen a lot of reports in the press about fintechs complaining about the success of or the openness of these APIs in the UK so far. The OBIE is supposedly putting in enforcements on that, but we really haven't seen true success yet in terms of unification of customer journeys and things like that.
Akbar, any follow-up on that one?
Look, I think there's a couple of points here, right? One is a lot of the incumbent banks have the older technology, right? And so I think probably some of the reports were related to the fact it was hard for them to move quite quickly to certain deadlines, right? And I think that's why, you know, without plugging Finastra too much, we've taken a platform approach, right? You open up the APIs, you take some of that technology and you enable it to be plugged into third parties, right? And that is part of the API economy, right? So, but I do think there's a business decision that needs to be made by the incumbent banks, which is what kind of bank do they want to be in the future? And technology can enable that change.
Any comeback on that, or any other questions? Well, I think it just remains to me to ask you to join me in thanking the panelists for a really illuminating conversation. Thank you very much. And please, a big round of applause for the guys.